What's going on? Alex here, and today we're answering some questions from Reddit. This question comes from Chill Bra Baggins. I'm 34 with no savings, no assets, terrible credit, and just landed a high-paying for me job. Where do I start? Without going into too many details, I've dealt with addiction my entire life. Finally, kind of getting my shit together, and I wonder if there's some kind of guide, book, or other resource for someone in my position. I'm 34, single, no kids, no savings, no assets other than my car. Currently have $400 in my checking account and have never opened a savings account. I'm starting a job tomorrow that will pay about $6,500 a month after taxes. I've got about $1,000 from debt from old medical bills and my credit is terrible. I know everyone always says the first thing to do is put together a 6-month emergency fund. Other than that, I'm clueless. I've never even really considered that I would be in a position to own a house, and I'm not really sure if that would be better for me than continuing to pay rent. Should I save for a down payment for a house? Should I max out my 401k? Really don't know where to start. First of all, Chill Bro Baggins, congratulations. That's a beautiful thing, all right? So you're encountering basically an upgrade to your entire life. I mean, you're gonna feel different, you're gonna want to spend different, and that's where the issues could come in, right? So the first thing here to keep in mind is you gotta avoid that lifestyle creep, all right? You're gonna wanna get fancy, you're gonna wanna show people that you're moving on up, but at the end of the day, you really wanna keep your financial goals in mind more so than impressing XYZ, because who cares? Other than that, you're definitely spot on in looking at the 401k as an option to save. Certainly, if your employer offers a match, take advantage of that. And if you're making within the thresholds to contribute to a Roth IRA, do that as well. But don't stop there. You can also form a taxable account, open a taxable account at Fidelity, Schwab, any of these places, and just put money to work there as well. Now, it's going to be taxable monies, but here's the thing. As a financial planner, I always advise clients to have 3 buckets of assets available, okay? The first bucket is the pre-tax assets. These are your 401ks, your IRAs, and so forth. And those are monies that you have never paid tax on that you would need to pay tax in order to access, all right? So that's just one group, all right? The second group is the post-tax retirement assets. And now we're talking about the Roth IRA, the non-deductible IRA contributions and so forth. That's a second class of assets because you've already paid tax on it, but you don't have to pay tax to access those monies. So you have to pay tax in the pre-tax section. You don't have to pay tax. And in the third group are the taxable assets. Those are the ones that you would have to probably incur some capital gains to actually access. But the reason for this allocation between the 3 buckets is as follows. It's because we really can't determine what the tax laws are going to be 20 or 30 years from now. And if you need money at any point in time, the first question is how can you access it in the most tax advantage way, right? If you are in a bind and you only have money in your 401k, you have a humongous account, the problem is that you're going to have to pay taxes in order to have access to it. So if you want to buy a house and you have a 401k, you're going to need to make a distribution, pay the taxes on it, and go through this whole thing to access those monies. It may not be the most attractive way to go. So if you had a taxable account, let's say, you may be able to sell stocks in there for long-term capital gains rates, which are a lot lower than ordinary income tax rates. So you would have access to your money at a much more efficient way from a tax perspective. And this is going to help maximize your the value of your assets depending on what you want to use them for, okay? So 401k, number 1, you want to definitely contribute to that, especially if there's a match. Roth IRA, another great option. And then, you know, the key is to not stop there because you also have the taxable assets available and you could create yourself a beautiful account that grows over time, which has, you know, dividends, interest paid into it depending on how it's allocated. And that's going to help you build wealth over time as well. And having those 3 buckets is paramount because, as I mentioned, you know, if the ordinary income tax rate increases, then that's going to make pulling money out of a 401k much less attractive. Now, one example of the government changing their mind has to do with Social Security. Social Security was originally designed so that you pay in a certain amount and then you get a certain amount of benefit. But if you look at a Social Security statement from the past few years, you're going to see a statement on there that says, by the year 2030, we only expect to be able to pay 75% of the expected benefit. So there you go. You're promised one thing, but it turns out to be another. And there's nothing really protecting 401ks and IRAs or Roth IRAs or taxable assets from dramatic changes that can seriously affect how much value of your own net worth you're able to access and what that's going to mean from a tax perspective. So congratulations, this is a beautiful thing. You're able to get yourself out of a difficult situation and now things are looking better for you. I'm happy for you. If you have any other questions, drop me a line, questions@efrosfinancial.com. Other than that, thanks for watching.